Oh, meeting is now streaming live on YouTube.
Yeah,
And it's recording. Wow, there's so many red little things going on to the
I
left.
know.
Full broadcast.
Yeah, there's like two little eyes watching me now. That's what it feels like. Those two little red dots.
Yeah, the whole recorded thing, it's kind of, I feel like it's kind of weird at first, especially at first. And then after a while, you're like, we're just having a call. Like,
Yeah,
cool.
yeah, it kind of just fades away. And then you can watch yourself stumble and say stupid things, and it's just kind of weird to watch yourself afterwards, but it's still really fun.
It's how you get better.
Yeah,
Get better at the skill of talking.
Totally. Yep. Quick plug. One of my friends is working on something in that space. I don't know if it's actually quite, I don't know, maybe I shouldn't announce it quite yet. But anyways, it's about speech analytics and stuff. And you can record yourself, maybe even upload a video. So we might put the video through it, and it'll tell you like all the things that, with the ums and the and all the little ticks that you have. It gives you a bunch of analytics on it. It's how you get better. So
interesting.
That's cool.
Yeah.
That would be really sweet, especially with like speaker recognition in something. If you're doing these things all the time, to really just like see and track it over time.
It would be really cool, and it would be really interesting to see like, how fast you talk over time, number of like ums per minute or whatever over time. That'd be kind of interesting to track.
See if you can increase them.
Yeah.
Instead of get rid of them until you're an all based speaker.
You could just communicate via
Get managed. So this is cool. All right. Yeah. Well, CJ, I'll kick it over to you if there's any kind of motivating question or thing that was like, okay, we want to know about this, and this is kind of how it came up, and then I can maybe do a little bit of background of where I've been since Blog Club last year. So.
Sure. I guess all of this, I think, initially arose just through conversations. We were just like, we have this Discord. I think I sent you an invite previously, but we're having these conversations, and like sometimes like we're putting them in there, and we ended up like, I think Kristen read some article that like touched on UniSwap or DAOs and stuff like this. And then we all started getting like, I think all of us were pretty much online at that time, just over the text, and we just started messaging back and forth. And we're all just like, we know UniSwap is pretty interesting. Like it kind of took off, and just more background. And I think at that same time, I had just had a conversation with you, or relatively recently. So it was kind of just like, I don't know. I feel like my knowledge is still like from you, but it would be just great to like more come from the source in a way, or like everyone's questions who has questions can kind of go through it, or like, totally. Why did UniSwap arise in the first place? What is the history with UniSwap and SushiSwap, as well as the rise of like the DAOs within it, and then more like fundamentally maybe like how it works as well, and or like some four like base questions.
Yeah, totally. There's a lot to cover there. And so this will be fun. I want to disclaimer, I'm no expert on UniSwap, especially the newest stuff, UniSwap v3. That stuff it's on my big list of things to get to dive into, to really dig into some of the math on how that works. But I just kind of know at a conceptual level. But I can kind of I maybe amateur historian is decent enough. I can get us to that point of when UniSwap v3 launched and kind of what's happening. I haven't really been super plugged in the last week, but probably pretty recently as to what's been happening. So we can walk through that. It also sounds like I think for Blog Club we had read that other internet post Squad Wealth was that, and I think that's a really interesting post because it was basically, I think, around that time where a lot of people were awakening again to like the idea of, okay, well, crypto coordination, money, okay, what's going on here? And so I think around that time, who's the woman who writes Check Your Pulse? That's sorry, is it?
I don't know this one.
Check Your Pulse, but she kept on started talking about crypto too, and so kind of to like pick up where I left off. So right after that, I think Blog Club, we started, Caden started meeting a little bit less and less. And around that time, I was starting to get more and more into crypto. And it's perhaps one of the things that was really interesting to me is when I started getting back into crypto at the end of 2020, there was a little gift waiting for me from Uniswap. I had used Uniswap maybe a year and a half ago, sometime in 2019. I just made a trade, really small. And when I went back to the Uniswap website, it's like, hey, claim your 400 uni tokens. I was like, hey, what is this? It's free internet money for doing nothing. And then I later found out it was because I had made the trade and I had been part of the I guess an early-ish adopter to Uniswap protocol. And so that basically was one of the few things that I started looking at when I was trying to get back into crypto. Fast forward a little bit, now working at a company called 0x Labs. 0x Labs is the steward of the 0x protocol. It's another protocol for decentralized exchange like Uniswap on Ethereum and some other chains at the moment. And that's what I do right now. I do not write smart contracts. I write code that helps market makers facilitate some of the off-chain kind of capabilities that 0x does. But we can dig into 0x a little bit later. We'll focus more on Uniswap. So kind of my like distance from Uniswap is I've used it currently and working at a company that aggregates many decentralized exchanges. Uniswap is one of them. So I'm kind of like by proxy kind of related, but not an expert on Uniswap itself. So anyways, that was kind of a long-winded explanation about myself and some of the ties that we all have to Blog Club and Squad Wealth and how that all connects to all this stuff. So anyways, if anybody wants to kind of just get started, maybe like, I don't know which part we want to dig into, how it works, exactly what it is, or yeah, floor is entirely open.
I don't know where to start.
There's a lot.
Yeah, so your felt sense, so you got the 400 uni tokens from that drop, right? And like, I guess sort of the social aspects of what's happening there, and then how that ties into like the trading offerings that they've got. Like, what is the environment like? What does it afford that maybe like traditional markets didn't afford? These kinds of things. So maybe there's somewhere in there.
Definitely. Okay. Yeah. Let's start. I think it's pretty. Let's start with something a little bit more grounded, which is like how it works, and then we can talk about what it feels like to use it and what it feels like to be a community member of it. I think that kind of lines up with kind of the questions that you presented.
Cool.
So Uniswap is a decentralized exchange on Ethereum, and we contrast that to a centralized exchange like a Binance or a Coinbase. And so what does that mean? It means that when you're trading on Uniswap, there's no centralized server that you're relying on. You're just relying on the Ethereum blockchain itself. And the Ethereum blockchain allows you to execute smart contracts. And what you're doing when you are trading on Uniswap is you're actually trading against a smart contract. There's a few ways to do that. One way, perhaps the easiest way to think about trade is, for example, Dave, if you and I were trading, I could just say, hey, I am offering some token A and you're offering some token B, and we find an exchange rate that is okay for both of us, and that swap happens. The one way to do that would be, I send you my token A, and then you send me your token B, and then, but it kind of sucks for whoever goes first. And so you want to make that atomic. It's pretty easy to code that up on Ethereum as a smart contract, but you can do it such that basically it happens at the same time or not at all. And so those first decentralized exchanges, Ether Delta, 0x, kind of operated with that kind of trading. It's a peer-to-peer kind of method. But Uniswap was amongst, not the first, I think Bancor might have been the first, or maybe they weren't even the first. Who knows? In this world, who knows the first version of the idea, right? It's hard to say. But Uniswap was probably the first to get traction with this, which was instead of trading with you against a direct counterparty or another peer, you actually trade with the smart contract itself. And so the way that works is instead of like me or like if you want to trade for token A and you have token B, instead of finding somebody else with token A, you go to the Uniswap smart contract that's essentially a pool of token A and token B. And you say, hey, I have some token B. I would like some token A. And that pool says, great, I can offer you this at this exchange rate. And you put in your token B and then you get token A. It's really that simple. The magic kind of is, how does it even know what price to even quote you? Because that's always changing. Yeah. Like, how does it, like, how is that possible? And so that actually, the big, so I don't know if this was Vitalik or somebody else, but I do know that Vitalik did have a like request for a project or something. He's like, hey, I would love for somebody to make what's known as what I'm calling, I think, a constant product market maker on Ethereum. And the idea there is, if we have a simple mathematical formula, we can basically always quote a price. And essentially this formula is going to do the same job as what perhaps market maker might do, which is, hey, here is how much I'm offering this amount of token B, how much token A can you get for that? And the formula is really simple. It states, you might hear this a lot of times when we talk about Uniswap, X times Y equals K. So I don't know if you've heard that, but it's like this curve. You might hear constant product, AMM, automated market maker, constant function market maker. So AMM, CFMM, these all refer to an equation that will always quote you like a price, amount. And the way that Uniswap works, and this might be a little bit too much into the weeds, but you have two pools, two amounts of token A and token B. And what you do is you multiply them. And you say, okay, I have 100 token A, 100 token B. I'm going to multiply them, get, I think that's 10,000. and that 10,000 value K, I'm going to hold that constant. And if new token B comes out, comes in, I have to reduce token A such that K is still 10,000. And this is just a scheme. You can choose many other schemes, but this is just one scheme that allows us to always quote. So that means the big innovation here is Uniswap, the smart contract, is always quoting. There's always a price. You can always go to the smart contract. You can always trade. This is so much better than having to wait for somebody else to come along and say, hey, I'm offering this amount for this amount. And I'm like, okay, I want that, or I don't want that, but I have to just wait for them to make that quote. Uniswap is always quoting. And so that was perhaps really the magic of Uniswap. For example, when I was trading on Uniswap, I was trying to trade some Ether for some MKR, which is the maker token, right? And back in the day, when you wanted to buy some MKR in late 2018, you had to use, I don't think you had to, but perhaps the most liquid exchange at the time was something called Oasis Dex. And you had to make a transaction to the Oasis Dex and pay for the gas for that. And then say, that's like your quote. And then somebody else would come along and be like, okay, I want that quote. And then it was an order book on Ethereum that was very expensive to operate and use, and very, very, very annoying, because you rarely get the price that you wanted. And I would put in like trades in the morning or orders in the morning, and then check to see if they got filled later in the day. Oftentimes the answer was no. And like, basically I was just trying to buy like, $100 worth of this thing.
Yeah.
It took days to make that. So when Uniswap comes along and you literally can like make that trade without doing any of that, it's always quoting. That's magical, right? And that's when I made that trade, I was like, oh my God, I spent me 2 days to try to execute this thing. I was able to do this in 12 and a half seconds. And so that is perhaps what people experience as the magic of Uniswap. So anyways, that's a lot of just kind of like, it might be too low level, but that's kind of how Uniswap works, and perhaps what it feels like to use Uniswap, at least why it was such felt like a big, revelation at the time.
Yeah. So like is there an equivalent in traditional markets for something that works like this? Or is this just
okay? So
yeah, and
because Web3 exists?
just to piggyback on that, does there need to be a seller and a buyer? Like, do you need that sort of like, or not necessarily, because the contract sort of handles that?
Yeah, the contract acts as the they're always the counterparty. So you always
Okay.
have, if you're a seller, there's always a buyer. If you're, or it depends on, you know, which way you're looking at it. If you're a buyer, if you're a buyer of something, there's always a seller, right? And
Yeah.
so there's always so there's always somebody to trade against, which is actually a robot in this smart contract. So you're always trading against them. Now where do the tokens come from is another story, and that's what you might hear of called LPs, liquidity providers. In traditional finance, there's definitely people who are market making, and they're oftentimes essentially they play the same rules as liquidity providers. They may, I'm not sure if the terminology is the same, but usually they referred to as market makers. And so in most, I want to say, I don't know too much about like non-equity markets. I think I've never traded those. I don't know anything about bonds. I know they're a lot more illiquid, and so there's a lot. It's a lot more finicky over there. But with equities markets, I believe for the most part, something like the Nasdaq, there's an order book, and certain parties are allowed to post to that order book, and other ones are allowed to take from the order book. I'm not sure if I don't think we're allowed to. We go through like a Robinhood and all these other guys that have relationships with ultimately a party that can. And so, but there's people who are market making who can always that are always providing liquidity, and they're always quoting. And so the reason why we don't really think about, like, it doesn't really make a whole lot of sense in a traditional world, because it's these market makers, they're doing such a great job, and there's so much liquidity and so much like you don't have to bootstrap a market. So the idea is,
Yeah.
for example, like if you're trying to buy some Robinhood stock today, there's enough buyers and sellers who are posting to that order book, and some people are they're just quoting different amounts, and there's a little spread, and you can cross that spread and take it and buy or sell, right? And when you have a market that's like pretty healthy, it's working, and essentially all that really matters is how big that spread is, and how deep the liquidity is. So essentially, if you are trying to trade $100 million, you're probably not going to get the same price as someone who's just trying to trade $5. You can imagine someone who's trying to trade a big amount is going to get a worse price, and that's the term we call slippage. But anyways, so in traditional markets, they're pretty healthy, they're robust. Getting them started is difficult, but it's not as difficult as for something super illiquid like a random DeFi token. Somebody just creates a token, for example, like I could make Phil token, and there probably is already a Phil token on Ethereum like 10 times over. Each one is, some questionable project of its own. But anyways, to get that started is actually very tricky. And you would have to get a market maker or somebody to do that work for you. On Uniswap, it's done by a smart contract, which is the beauty of it. So bootstrapping these long tail assets is just as good as bootstrapping, something very, very, very liquid. So it basically makes it really easy to do an IPO of sorts.
Yeah.
So it's essentially the IPO is deploying a pool, or not the pool, deploying. Not the pool, but I forget the exact terminology, but the smart contract that represents the pool of two tokens. Once you deploy that and put a little bit of liquidity on both sides, you've done your IPO essentially.
This is where the staking stuff comes in, yeah. Like, because there's some game to get the pools to match and this kind of thing, or how does that all work?
Yeah, there's games there. There's Ponzi's and all sorts of fun, economics, kind of, the bubble that never pops kind of idea. But I think, we can talk about staking as well. There's a concept called yield farming that's pretty interesting. There's the concept of what a token is, and why having all tokens of the same standard is so powerful. So yeah, we can go in that direction if you guys are curious.
Actually,
Yeah, I
have
think
one
it.
question. Maybe
Go ahead,
like,
CJ.
but before that is, I guess like I think we talked about this before. Is like I just was like curious, like who is providing the liquidity? Is it like whoever is
That's
like
what I was gonna
initially
ask too.
who is initially doing the IPO? Are they providing both sides of the market? Are they putting in like 100 ETH and someone on the other side they're putting in like whatever they want the initial exchange rate to be, or like how does that work?
Everything you said is correct. Yeah. So to kind of recap what CJ was saying is he was asking, well, wait, hold up. Let's talk about who provides liquidity. Where's liquidity coming from? You can't just materialize these tokens from thin air. Well, you can, but not the pool contract isn't doing that. And so where does the pool get its liquidity, get its tokens from? And the answer is from anybody. Anybody can find the pool and say, I would like to make this market, help make this market. And I want to put in some of my capital such that this market is more and more liquid. So one thing about UniSwap, it works better when you have more tokens in the pool. Because that actually, you have to do the math out, but that reduces what we call slippage. It means that if I want to move a larger amount, I will have less price impact, right? Like you'll see it on the UniSwap website. It's like, how much price impact do you want? That's because when you are trading, you're actually, you're moving the amounts of pools, and the pricing is determined by what those amounts are, right? And so when you're moving it by a lot, your pricing is going to change a lot because again, your price is determined by the amounts. So when you have more and more and more, just tokens on both sides, then when you make that trade, you're not going to move, the exchange rate by very much. And so it's in Uniswap's best interest to actually have lots and lots of money locked in their pools. And so if you hear things like, I always like dyslexia this, but TVL, TLV, I forget which one it is, total value locked. It's important because in these pool-based smart contracts, that reduces what we call slippage, price impact. That just makes these, it makes it a lot easier the experience is a lot better to just move money around when you have deep pools of liquidity. And that's true not just for Uniswap, but a lot of these pool-based protocols that quote some sort of price or APR based off of how many tokens are there. So you want more tokens oftentimes in these pool-based contracts. So then the question is, okay, so basically anybody can come along and they can deposit some tokens into this contract. What are they doing? Well, they're depositing tokens such that the amounts on both sides are equivalent. Or if you're the first person to do it, what you think it is equivalent. So you're setting the exchange rate to say, hey, this token A on the left is equal to this amount of token B on the right, even if that's not true. And then somebody's gonna come in and arb your ass. So, but anyways, what'll happen is when people want to add liquidity, they put equal proportions on both sides, assuming that the market is efficient and that pool is quoting the market rate. And so you put in tokens on both sides. And this is a really interesting part. And this relates to your question, Dave, or your point, Dave, about staking, is you put those tokens in, and what the pool gives you is actually another token back. And that token is a receipt. It basically says, this is a receipt for ownership of this percentage of the pools. So now you own this percentage of the Uniswap pool, of this pool. And what happens is, as the price moves around, the relative balance of these things are going to move. You can go to the Uniswap and say, hey, here's my receipt, give me back my percentage of the pool. And that's essentially what you're doing. Now the question is, why would anybody do this? Is it just because they want to help Uniswap get deeper liquidity? And the answer is no. The answer is they get compensated for it. And there's a few small lies that I mentioned. I mentioned this concept of X times Y. There's always this concept of K. K stays the same. K does stay the same usually, but there's one small thing that we need to talk about, which is when you trade on Uniswap, you're not actually getting that X times Y equals K, the output of that. You actually have to pay a small fee of 30 basis points. And that actually goes to liquidity providers. That's shared amongst everybody who put in liquidity. And that grows as people trade back and forth. And so the idea of that compensates people for putting liquidity in. And so now you're like, okay, well, this makes sense for me to actually put in liquidity, but that's better for people who are trading because the more liquidity means better pricing. And so, if we make these pools really, really, really deep, then all they're really paying for is a small fee to compensate us for facilitating this trade. And that's where the idea of an automated market maker comes from. You just deposit your funds in the pool, and it's always quoting, it's always letting you trade, you're always facilitating, you're always making the market, and you're always collecting fees, which sounds great to the naive mind who's not very well versed in how all of these things work. But when you start diving in, you realize, okay, there's actually another part to it, and that's kind of the mathematics of Uniswap. There's another concept called impermanent loss, which is another topic that I think we should talk about if we want to dive into kind of the economics of market making. Yeah. But the idea is there's no free lunch. You're not just getting fees. You're on risk, and you're getting compensated for that risk. And sometimes you're not getting compensated nearly enough.
So the fee structure, is that like set? How is that set?
Fee structure. So they in Uniswap before V3, I believe all pools charge 30 basis points, and that's just flat across the protocol. That's the same for Sushi Swap, Pancake Swap. I think maybe not Pancake Swap. Don't quote me on that. Most of the forks have kept that the same, or they've changed it by some constant amount. I don't know what I'm talking about. But so it's just set by the smart contract, and it's hard coded in there, I believe. And so that answers CJ's kind of question: who's providing liquidity, where is it coming from? And it also goes into the concept of staking. How do you stake? Well, the staking is an interesting concept. So it builds off of the concept of the receipt I talked about. So you have two tokens, you deposit them in equal proportions into the pool, you get a receipt, which is another token. And then what do you do with this token? You can sit on it and do nothing with it. But there are some projects that say, okay, we want you to help us market make essentially be a market maker for our IPO, basically. And we're not an IPO. That's would not lose. Okay, I'll probably get in trouble, or let's not equivalent too much. But it's this IPO,
an offering to the public,
an offering to the public of tokens. Yes. And if you want to help us, make these more liquid, then you can. We'll reward you for it. And we want to see proof. We want to see proof that you're doing this. And so what you can do is you can take your receipt and lock your receipt in our contract. And as long as it's locked in our contract knows for sure that you are basically you've done the work of providing that liquidity on Uniswap. And so we will now reward you with tokens based off of how much you are providing in terms of liquidity. So how much percentage of the pool you own, as well as how long you stake with us. And so if you are like, okay, I want my receipt back for whatever reason, maybe essentially you want to take your tokens out of Uniswap. But as soon as you do that, you stop gaining the staking rewards. And so the staking rewards, as it pertains to Uniswap, are rewards for basically being a market maker on the Uniswap exchange. That another project, for example, Phil token, and I want people to be able to trade this. So I'm like, okay, Phil token is going to be tradable with ETH. And so if someone has ETH, I want them to be able to trade for Phil token. And so if everybody here deposits, tokens on both sides, and then comes to me and says, hey, Phil, here's, the receipt, they call them LP tokens, liquidity provider tokens. Here's my LP tokens. I'm going to deposit them in your contract just to prove that I have them. And then I will now give you Phil 2 tokens. And so Phil 2 tokens are like, okay, there's another token, or maybe they're just Phil token themselves. and that's a reward for doing this. So that's one form of yield farming, especially as it pertains to things like Uniswap and SushiSwap. The concept is all the same. But so there's many forms of yield farming, but that is perhaps the most popular one. Is I want to reward you for doing useful work by helping my token become more liquid, and then when you prove that you've done that work for me, then I will reward you. I'll compensate you with some token, which hopefully you will hold on to be part of my community. But you could also just dump it, which is there's all sorts of perverse incentives there, and so there's a lot of people are thinking, okay, well, what if instead of rewarding you in tokens, I rewarded you in options, just like we reward employees with options, not necessarily liquid stock until the company goes public. Once it's healthy enough, it can withstand all the dumping. So the people, there are a lot of discussions that are happening around that, but that's how yield farming as it pertains to Uniswap works today, or worked in V2.
Yeah. So all the mechanics make sense, and then all the variables that you can play with, and I'm curious about the interface to this, because I haven't really played with it too much. So specifically in the case where you're providing liquidity, and then where is the contract for getting rewards? How is that sort of mediated? Do you go through, is Uniswap putting a front end on that, or is that through the projects, or
So let's talk about the different front ends that you'll see. There's going to be a front end for trading. So if I want to trade, if you just go to, I think, app.uniswap.com or something like that, you'll see the very, very simple interface. It was revolutionary at the time. Basically just say, I am trading this token, and I want this token output, and it'll quote a price. Or alternatively, I don't think a lot of people do this, you can say, I want my output token to be this amount. How much token do I have to give you? And so this is a huge headache as an engineer building on top of this, because they offer that UX. That so many annoying problems for us.
Interesting.
But anyways, it's
we should dig into that at some point. I'm curious, but
that's like it's a minute thing. It's like, if you support this feature, it's not the end of the world, but it's like you kind of have to invert a lot of your thinking about stuff. But anyways, so there's going to be UI for traders. There's going to be UI for liquidity providers. So I think that's the pool interface. So they're going to see a very separate one. And then when you pool your liquidity and you get those quote unquote LP tokens, receipt of your market making, of your liquidity providing, when you get that receipt, then you actually go to another website, for example, philproject.com. And then you deposit in my staking contract. So you have to trust my staking contract is not going to steal your tokens. I have not dug into this, but I believe Synthetics is the OG staking kind of contract, and everyone now, a lot of things in Ethereum and crypto, once somebody has created a good contract, everyone models their stuff after that. And so I don't know if it's become a standard. Open Zeppelin makes a lot of token standards, or not just token standards, but smart contract standards. I don't know if they have a standard for staking, but Synthetics, I think, is the one that everyone models themselves off of. So there's two websites, one Uniswap, two philproject.com. Uniswap has the trading and the pooling, and the staking happens on the other project's own website. And that's kind of goes to show you how composable these things are.
There's some sorry, go ahead.
Real quick, is there might be jumping it back a little bit too, but is there best practices around what percentage of your tokens you would put into the liquidity pool to start, and then how you either sell back into that liquidity pool to withdraw fiat money or whatever the pair token is? How are people thinking about numbers there in terms of capacity and supply?
Oh, that's now the game aspect of it. I don't know. I don't know the exact what people tend to do. Do you mean like, so I guess I'll just, like with the game also depends on the party that is conducting this. Are you talking about as an LP, as a developer of the project that is offering liquidity on Uniswap, or trying to launch their token on Uniswap? Talking about a trader, like which individual or actor are you?
I guess for like a project that's doing like, hey, let's
Ah,
create a token and fundraise because we want stakeholders and see where that goes. Like
gotcha.
how would they be thinking about like, yeah, initial?
This is a really good question. I don't think there's a good answer for it. Token distribution I still think remains like one of the hardest like questions in crypto. And there's concepts of like you like if you have the token where one person holds all of it, it's pretty much worthless. But then like, so is the ideal distribution that everyone gets a equal amount, and how do you make that happen? It's very, very difficult. You airdrop to random addresses. So it's very, 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 very tricky. But when it comes to Uniswap, I think this is again best left to people who are serious market makers. But I think what you want to do is you want to make the market such that the people who want to trade are getting acceptable prices that they're willing to accept. And that's not a very good question, very satisfying answer. But essentially, I think what you want to do initially is have enough liquidity such that people can of the people who want to use or gain access to your token, there's enough liquidity in there that they can get decent prices. But then once that happens, then liquidity providers will see an opportunity, and then they'll be like, oh, okay, well, I can make money by providing. There's a lot of volume here, and that'll attract them. So just getting it started can be a little bit rough, but I think over time it will naturalize. I think the more interesting question is what percentage of the total supply do you release and get out into the world? I don't have a good. That's I guess it's like a really, really deep research topic. I haven't researched that very deeply.
Makes sense.
But that's a really good question. I think figuring out the art of I don't know if I mentioned the term fair launches, but the art of launching a project and a token is I think we'll be learning from this for a very, very long time, and I don't think anyone's perfected it.
What's the like TLDR for a fair launch? Like
the fair launch is sounds good in theory, but if you read the team that really, I don't know, I wouldn't say they pioneered it, but they really, really popularized. Well, maybe they did. Actually, I'm not sure about the history here. But they're perhaps most associated with it is Yearn. And Yearn, everybody loved Yearn for doing a fair launch. And the way that you do fair launch is you stake some amount of some random. So for example, I'm launching a new project and I'm saying, okay, I want to attract people from different communities already. So if you have the Uni token, come here, bring your Uni token, stake it in this contract, and I'll give you some of my new token. There's 0x as well. I want you guys as part of my community. So if you have 0x token, come here, stake your 0x, and you'll get some too. And essentially, you set up little bounties for each project to come in, deposit some of their stuff, and being like basically committing that, hey, like I exist, I'm showing up for the token. I don't know like what else you're doing, but you're basically like, hey, I want to be part of the community. I don't think that's a really strong signal, but it is what they used, and people love this because they're getting free stuff for. It's like, oh, I take my Apple stock and now I can get shares of Stripe for no reason. That's amazing. Yeah, I want to do that. It's essentially what it was. So the community loved it. Everybody who was part of it, because they were just getting paid to do for just breaks for showing up. But they weren't doing any, like, in my opinion, very useful work. There might have been more. There might have been some LPing stuff. There might have been, rewarding once there was enough token. Might have been some liquidity mining. I don't know, but all of the tokens got released through that, and the developers, the core team that worked on the project, did not allocate any for themselves, and so they had to get it. They had to earn it the same way that everybody else did, and so they ended up having very, very, very little amount of the token, and so there's, in my opinion, it's pretty seminal. But there's a post by the creator of Yearn, Andre, I think, called "Why Building in DeFi Sucks," and essentially he bemoans the problems that arise when you do a fair launch like this. And so you actually, and Urine retroactively decided as a community to be like, hey, actually, even though this is really great for the community members, we got to protect the team members, because if the team isn't excited about this, then they're just going to like give up and the project is going to go nowhere. So what they decided to do is they minted, I think like 20% of or so of the supply and allocated that towards the team. And so they minted more tokens so that the team could get some in and now everyone's happy. So that's what happened. That's the fairest of launches I think I've heard of. And it didn't, even though like the community loved it, the team didn't love it. And then the community realized, oh shit, if there's no team, the token's worthless. Well, eventually will be worthless. So, or maybe not worthless, but I really want the team working for me is essentially what they realized.
So the team came to regret it, but is it still a pattern that other teams are employing for some reason, even though the initial?
I haven't been following very closely. I think there are some that do it, but it's not super popular. Most things I think still follow the not super popular, but not unpopular. But it's like there's a bit of an anti VC vibe to a lot of crypto. It's kind of a populist nature. Very, very, very interesting stuff on that whole another topic. But I think most projects these days still like are pre-token before they launch. They launch an actual useful project, and then they slap on a token later, and they reward people who are initially part of it, and then they allocate some portion to investors in the team. So that is perhaps, it's still pretty much a traditional way of doing it. I think Yearn is one of the most interesting projects to me because they are so decentralized, even compared to most other projects which have a founding team that are that perhaps raise money, and this is how most things are financed in just the world of tech, and so they're different. And so I think Sushi is actually another one that is similar. I forget exactly how Sushi's token got distributed, but yeah, there's a handful, but I think most are still traditional: raise money, build a project, build something that's actually useful, finds product market fit ish, and then launch a token afterwards, which is not a fair launch.
Cool.
Yeah.
Thanks.
Because they're mouths to feed now. They're basically people just like dirty VCs, like, oh, they're trying to they have unfair access, and there's truth to that, but there's also like there's a reason why projects that follow that model tend to succeed more than projects that don't necessarily follow that model. So I don't have very developed thoughts on whether or not that's good or bad. It just is.
Yeah, it seems like it would vary per project too.
Yeah, depending on what you're trying to accomplish with the thing. There are probably like really capital intensive endeavors that these models are like too slow, or the coordination cost is too high, these kinds of things. So
definitely that's a really good point. Yeah, for things that are very capital intensive, or maybe I guess not necessarily capital intensive, but like labor intensive, right? That require a lot of engineers and people to build this out and market it and develop the community and all that. Like you need to compensate people for some of that labor. Maybe the community building can be organic, but some of the labor, you got to pay designers and you got to pay people. Or maybe you don't have to, but it's definitely a lot easier if you have a big bag of cash.
Might incentivize people a little.
Yeah, exactly. We've got some incentive juice.
Yeah, I mean, people understand that game. So it's a highly legible game that's been stress tested for 500 years. So, people know what they're getting. Yeah. So, yeah, it's interesting. Like the incentive structure is changing around there. But yeah, go ahead.
I was curious, like, I guess even with the more traditional launches, like when they're distributing these coins out to the initial developers or whoever, is it like just going all in one shot, or are they like releasing it over time or something like that to make sure that you encourage continued development?
Yeah, there's time locks. It's basically standard 1 year, like 1 year cliff, 4 year vest kind of tokens. So something like that. So a lot of, but what's different is after 1 year they're liquid, as opposed to 1 year you get options. So, and part of that is because I don't think we have very robust options in DeFi quite yet. They're developing, but not every you can't build options for every protocol. Every token. So
yeah,
coming,
I mean the demand is probably not there yet. No. Anyways, getting the tokens to be valuable at all was the first step. So then you can start building abstractions on top of that, I guess. Yeah.
So
okay.
Can any token list on the exchange? Like how do you do that? Like what is the process?
Yeah, it's a really, really, really good question. So I haven't done it myself. I don't know the exact steps, but what the conceptual steps is so there is a smart contract that UniSwap operates that is called, I think, the factory contract. And essentially, if you're familiar with the factory model or factory design pattern in software, essentially, it's just an object that creates other objects. And so this factory contract creates other contracts. And what are those other contracts? Those are the pool contracts that we talked about. So what you are doing is you send a transaction to the factory contract, and that factory contract on your behalf deploys another contract. So it creates a new contract that is that pool, and it registers it such that UniSwap knows about it, and it doesn't create another one.
So anyone can do it.
Anyone can do it. Yeah. So that's the real question. The real answer to your question is anyone can do it. Yes.
Interesting.
However, there's a big debate happening as well, which is at the smart contract level, interacting with the blockchain itself, anybody can do it. But most people don't, because they actually use a UI, and you can censor at the UI level, even though you don't censor at the protocol level, right? And so that is possible as well. And I think UniSwap has already unlisted some tokens from their UI.
What's the governance body around all that? Like, how do you structurally, like, what is? I mean, I know there's a crazy treasury, and I know the proposal systems and all this crazy stuff. What's your feeling on all that?
Other Internet just dropped a really good report on the community in Discord on Uniswap. So that's one aspect of it. But the short answer is actually not entirely sure. Is that for a lot of projects where you start off with a team and you have a VC raise and all of this, it's very much going to be team oriented. And the community really listens to the team. They'll engage with the team. They'll push back against the team. But it's like the team does X, and you can say no or yes to that. It's not right now. It's not so much that community is proposing Z, A, B, or C. It's mostly team led. And my sense is that most projects will be like that, just like for a very, very long time. There's Maker, I think, is on a path to decentralization, but it'll be interesting to see who steps up over time to make changes to Maker. Will it be former members of the Maker Foundation, or will it be community members that, like, how do they do onboarding of these new people, right? It's all these, like, there's so much stuff that is hard to say what will happen when it's fully decentralized. But right now, I would say a lot of projects are very, very much team driven, and they want to what is the term that Compound uses? Exit to the community.
Yeah.
So the idea is that you want to exit to the community by empowering the community so much that they are now your team is not needed, and it can dissolve, and it's autonomous from the perspective of the original team. Now,
this may be an aside real quick, but can you explain the economic upside for that VC deal to have one of these things exit to community, this thing has been plaguing me. Like, why is it better than, like, you know, whatever X return in a, you know, acquisition or a go public or whatever? Like, is there a like, you know, order of magnitude difference in that or something, or complexity, or
What I will say is when something is sufficiently decentralized, I think it no longer passes the Howey test, or essentially, it is no longer security.
There it is.
Yeah, so there that might be a reason.
Sure.
I'm not sure.
Big reason. Yeah, it would be a good one.
That might be a reason.
Yeah.
I think the idea is also that once it's owned by the community, you know,
Sure.
you don't necessarily have to. You don't have like an expensive team necessarily. Although, like at the end of the day, work needs to be done, and so like who's doing the work, who's getting compensated for it, you know, like
there's an interesting tension in the leadership versus decision making thing in that. So it sounds beautiful. I'm just very curious about on the ground how it's working. So this information that these teams are primarily like organized in like sort of a VC adjacent mentality, and then that is how the structure of the thing is developing. That's helpful in understanding the difference between
Yeah. So it's a goal for a lot of teams to eventually decentralize. And then what a lot of, I think the vision, like some people want to dissolve, some people want to say, okay, the team is now just one of many players in the space, and they're no longer any more privileged than any other player, except for having a lot of the tribal knowledge of what happened before.
Yeah.
Over time, that will dissipate and become less and less of a thing. So there's I think a lot of teams are thinking along those lines. Either you decentralize, and now it's like there's no like legal entity, at least, you know, by the purview of, you know, certain country or whatever. It's just a collection of humans, or that legal entity still exists, but it's no more privileged than anything else in the past. So that's kind of,
I mean,
I think
you don't
approaches, but there might be more.
Yeah, cool. Thanks.
You just said tribal knowledge. I'm just trying to backtrack for where you pulled that from, or like where that,
Oh, yeah, in the sense that so if I am working on a project and I essentially want to dissolve my team and basically have the community really own it.
Gotcha. Yep. You have to share that.
I have to get that tribal, like this is really important to get that tribal knowledge to be embedded in the community. Otherwise, if we disappear, then everyone has to it's an archaeology project again. And it's like, what the hell happened here? Why is this like this? We want to make any changes. You know, it's like inheriting a code base that you have no idea how it works. And you're just like, So any software engineer who's been dropped into like a legacy project has felt that pain. And it is not necessarily the most fun experience.
It's just, it's go ahead.
It feels similar even to where we're at, where we started something and now we've got this tribal knowledge of like what we've built to date and like wanting to bring additional people in. So sharing and then in the long run, the vision is that you've got a bunch of people working in like a shared space, on like a set of protocols and smart contracts, but they're each going to have their own tribal knowledge that you want to like sort of let percolate up, or there's some kind of communication protocol so that everyone is sort of aware of what everyone's doing in a way that is generative and beneficial and not distracting. So, I mean, that's a huge thing to sort of figure out, but that makes sense.
Super huge. Yeah. I don't know like how traditional open source does it. I haven't really dug too much. That's always, I think, one of the things that I want to do with Blog Club was maybe like we could do a block on existing open source projects and how they've been able to succeed and kind of just have succession from one benevolent dictator to maybe another, and you know, what exactly kind of happens. I mean, software is not that old. We haven't really had multiple generations of passing on open source software. But I feel like, yeah, it is. I don't really know what that answer looks like.
Yeah, I think that I have limited knowledge here, but I think that the open source community has sort of struggled with this, where what happens is a few people sort of shoulder the burden of the larger community because of this exact problem. There's a challenge in communicating what it is that you're doing and then passing it off to someone else. Like, yeah, and then you get this sort of like, I feel like, Dave, this might be more of your language, these kind of tech priests who are sharing like their knowledge and like giving of their time. Like they're like, it's effectively doing the internet lord's work because they're not getting paid a lot. There's not a lot of acknowledgement of what they're doing. People don't really understand what they're doing. People are using the code and then sort of dumping on them like, here's all the problems I'm having, and they're like just trying to keep the thing up for you to keep using. So yeah, but I think this is where Web3 has the potential to solve some of the problems, because it starts creating two-way streets of communication, and it's just easier to share information about what you're doing.
Totally. And the big thing is also compensation. So these people will get compensated for their work. And then they say, if I don't want to do it anymore, well, somebody else can get compensated. They can take my spot, and I can pass. I might have had I was carrying the torch of lead developer or whatever. Well, I've now traded my replacement, and it's now going up to a vote that we want that person to be the torchbearer. And so they'll get paid for it. And so that is another thing that exists in a lot of blockchain projects, that current open source projects don't have that luxury.
Yeah, there's also a meta game here that if succession is a baked in problem, like in the sense that like you want to dissolve your particular influence in the system once it is no longer viable, or you want to move to somewhere else, but there is something that you've done that is or you are maintaining, you are stewarding within the system, then like developing a custom or like a sort of practice within the community or organization of like documenting or conversating out what you're up to and how you're doing it. So you're inadvertently training as you are building the thing, so that you have people who so you're broadcasting out your position, so that, this is the media thing that we're doing now. Like if you're talking about it in public, you're working in public, then people who are naturally interested in that area can start to glom around you. So you don't have to go out and find it's impossible to do that. This is always this is where you have like the CEO thing, where one of the succession techniques is to have another person train with the CEO, shadow them like over a long period of time in a sort of apprentice mentor model or something like this. And then the dictatorships did this too in Rome way back when. You had a system where, a son from another family would apprentice to a Caesar or something like this, and then was effectively trained as successor. So yeah, anyways, these kinds of models.
That's fascinating.
It's like life cycle stuff that we've talked a little bit about. Like if you can program into a life cycle the succession plan, because if that's sort of built in, it should have a life that can continue. And you could program that with smart contracts now, which is cool.
Totally. Yeah, no, that's such a cool kind of concept. I think so many things are problematic because we don't think long-term, in the sense of like, okay, what do we do when, we need to wind something down, or like when one person leaves, or we just think about like, the fun, open the new product, but you don't focus on, in 20 years, I'm going to have to say goodbye to this product. And how do we kind of return this back to the earth? Like we don't think about that. Now we have the landfills, right? It's a huge problem. That's so interesting.
Yeah, I think this is the social layer of these projects. What the economic layer is doing is exposing a bunch of automatable stuff.
Yes.
that like reduces the cost of like having to coordinate all this. Like the example in Uniswap where you can market make through like a tiny formula compared to having, a 500 person team trying to, do all the whatever the hell they're doing. I have no idea. Right.
So
I mean,
caveat on that is
sure.
the new version of UniSwap might require that 500 person team.
Pete, you can't get rid of people. It's not possible,
Exactly.
but you can make what they're
We
doing
don't
more
want
efficient.
to either.
No, it's
Exactly.
better. Yeah. But yeah.
Oh, that's another concept that I think there's this podcast that I think like if you guys are interested in all of this stuff, you guys will love. It's called Armada DAO, and
yeah.
it's all about DAO governance. And they read a post called governance minimization, and essentially why you want to basically so like or governance maximize. I forget exactly what it is, but there's some. Basically, it's like Bitcoin is trying to make it such that the protocol is ossified. Humans don't matter anymore. Code is law, unless something really bad happens.
Sure.
For example, quantum computers come. Okay, we gotta change that. So that kind of stuff, I think the Bitcoin community would be like, okay, fine, we have to touch it. But everything else, we're not going to touch. The Ethereum community, and I think most blockchain communities are like, hey, if something goes wrong that doesn't serve the humans, we're going to go change that so that it serves the humans again. Like it's we're not going to allow like this have to happen. And that's why, that there was the Ethereum hard fork and there's Ethereum Classic. Ethereum Classic basically retained all the people who said, no, code is law. We can never change anything, even if it doesn't serve the people. But the vast majority of people were like, no, like we need this stuff to work for us. Otherwise,
I mean, it's reflected in the price. So
exactly. You can see which kind of school of thought it's like
there's like culture associated with the different chains based on what they're trying to do. And it also makes sense with Bitcoin because programming money for just the sake of this sort of what's the word? Fungible exchange is a lot easier to do than the exchange of something non-fungible. And if you start getting into more dynamics of how people communicate and collaborate, offloading that into a machine is just, it's way more complex. We seem to be more towards the beginning of that. You could do basic things using technology, digital technology, but the more complex stuff, like we suck at it. Like healthcare, like helping people connect to healthcare, like that's super complex thing, but it's pretty like standardized, legible. But the experience as like a consumer in that world, it's horrible. Like the systems don't talk to each other. So I think we're sort of at the beginning of that. Like this communication technology works fine, but it's pretty simplistic. We're not collecting information and putting it on chain so it's composable from this point forward. We want to, but
totally. No, definitely. There's the blockchains as there's like figuring out exactly what they will do for society. I think is really, really trippy. I think it's like the internet is like, okay, information can now move freely and almost like without cost, and but now what we've been able to do is we move property now on the internet. That's what blockchains essentially allow us to do, and they enforce they enforce the property rights as well, and so figuring out essentially what the ramification of that is next level. I don't know, and then you have the accounting and ability to just like, hey, this is, if you want something if there's value to something being transparent and legible to everybody, putting it on the blockchain could potentially be very, very, it has value. There's financial value to that, and it's cheaper to make that accounting on the blockchain than it is to pay an accountant.
Well, and like if you put things on the blockchain and there's an ease of people being able to work with that information, like what we're seeing is that people will figure it out. Like just give them the tools to let them play with that information. And like there's no harm in the play side of it. So I don't know. There seems to be, it feels less destructive somehow. Like you can fuck it up and then, I don't know, fork it, go around it. I mean, it depends. Like if you need to, like, we don't know about how to deal with this thing, let's go make a mess with it. And then we take what we learn and build it back into and like reprogram the contract. So you could do it. Yeah. I don't know.
Very anti-fragile kind of approach.
Yeah.
Approach to, you know, the like stuff that's like we should take very, very seriously. It's like there's a little bit of irreverence, but there's people still take it very seriously. But because it's all open
serious play,
and people are you know, like there are hacks and there's some people, they're bad actors, and but it just it sees the light of day, right? Like, you know, everything sees the light of day very quickly. And if there is an exploit or something that could go wrong, usually very quickly somebody finds it. Usually, I mean, there's still going to be 0 days and stuff that get discovered much later. But you know, like there are a lot of smart people, like, you know, watching a lot of this stuff, trying to make money or trying to steal money or whatever. And keep everyone honest. Yeah. So I guess
the nice thing is that you find the patterns and then you don't have to remake them.
Yeah,
like you can share them forward. So that effort communally compounds, which means that like you're baking in trust by running into these problems. Like the version of the thing you talked about with urine, like they set out to do something altruistic with this like mentality of how the world works, you know, based on the information they had on the ground, and then released it to the world, got shafted, or created a problem that like, yeah. But then there was a mechanism to like redo that deal in a way that was in alignment with the reality that wishes to exist. Right. So like, you know, the projects that I think will tend towards success are the ones that can have this like adaptability baked into their operating principles and their incentive structures, which are inextricable.
Yes. Yes.
Yeah, there's another thing that came up, like Kristen and I have been doing we've all been sort of doing research around DAO stuff, but Kristen's been looking into the heavier duty policy stuff. And some of the things one of the things that got sort of bubbled up is the double meaning of the A in DAO, like automation and autonomy. Like, so that's like a sort of engine there. Like the automation should increase personal agency, autonomy in that sense, right? Like, and if they're not doing that, if you were just creating like a collective where everybody is an autonomous individual or something like this, then it doesn't necessarily work if you're over indexing on that. And then if you're over indexing on the like automation side of things, then you're extracting all the humanity out of your organization, which means you have to find this middle ground based on the field of play you're in. So anyways, that's
on the concept of like automation. I think one really interesting thing is, I don't think I mean, the goal is not necessarily to automate humans. The goal is to automate certain things that are corruptible, certain things that are I think that's probably it. The human aspects that are corruptible, and reduce that as much as possible. You don't want to it's like the goal is not necessarily to automate away all humans. I
think people fall into that trap though. They start to see things like this is the immutable case where you trust the math above all things, but the math is still finite. It is, a conception. So yeah, the balance there is like letting computers do what they do really well. Yes. And letting humans do what they do really well. You got a centaur. They're working together. Like projects that can like afford that relationship, I think they will tend towards success. Or be more fun at least.
I agree. Yeah. Essentially, blockchains as it's a really, really interesting kind of concept of like what are blockchains going to be. Some people have likened them to nation states, and it's the more I think about it, it's like, there are aspects of it that do encroach upon certain things that we rely on, the nation state to essentially, do for us. And And so what does that mean in a world where the nation state could potentially do less? Does it go away? Probably not. Can it focus on serving the people more better? In theory. We'll
Yeah.
see.
Yeah, I like the thinking around that effectively it's a mental model for designing DAOs and projects within the sphere. Like, because an innate part of how the blockchain stuff works is more like nations and markets than they
Yeah.
are firms. And
Yeah.
I'm pulling this from also some of that policy work. There's a felt sense in this, though, that like people are talking in terms of statecraft, market making, like states typically have a relationship there. And then the governance policies are around like democratic types of things, right? Or, tyranny, whatever, right? And like we're even talking about it in terms of like the Roman Empire and successions and these kinds of things, like because you have people with a vested stake. In the same way, they're more like citizens than they are like consumers.
Right.
So if they are being treated like citizens, then we have this entire body of knowledge of civilization design and these kinds of things that like you can look to as like they're little tiny nation labs, right? So they will have tendencies in that direction, like that are different than firms, I guess. So
Totally. And I think I really like that. I do think though, but as blockchains are more like nations than they like firms, they're still kind of like firms. They're still a little bit like companies, right? Like they're learning, like companies are really efficient at certain things, and they're really good at like they have a succession policy. It's onboarding and offboarding, and it generally kind of works. And it's like and it works at scale, right? Like with a nation, you might be doing that for 150 positions, but companies have figured out how to do that for literally almost every employable person. They found a way to have that succession policy, and so I think there's like this blurring of the line of what is a firm and what is a DeFi project, what is a firm, and what is a nation, what is a blockchain. All the lines are getting blurry right now, and it's like, okay, what are we doing? This is some weird shit.
Yeah, it's great.
What do we do? We did not just create peer-to-peer electronic cash. We did a little bit more.
It's the same like
we
centaur
the thing is,
thing.
we haven't built peer-to-peer electronic cash yet, so that's still not. We built peer-to-peer electronic gold. Perhaps not quite cash.
Close.
Yeah, nobody wants to spend that yet. What were you saying, Kristen?
Just the nation state company sort of like two sides of the same coin kind of thing, as is the human computer. Like it's a combination. There's aspects of both of them that are coming into play, but I think the governance is more aligned with civilization design, which is novel to think about. So like we've talked a little bit about if you could design the tokenomics within a DAO to take into account the health of the DAO itself through some sort of like universal basic income, like that's not typically how companies work unless you're getting a cooperative company.
No, that's an interesting thing. So UniSwap, of any VC backed project, I would say Uniswap is probably the closest thing to a co-op.
Interesting.
But it's not a co-op, but it's the closest thing we have to one, in the sense that the users, the people who are using and doing the work, are the owners, and as are the VCs, but it's a very interesting model in that sense. It's like there are aspects of it that I don't think, we might look back in 20 years and be like, okay, yeah, Uniswap, what they did with their airdrop of rewarding users, that was cute, but that wasn't exactly, that was, it wasn't perfect. But I think we'll look back at it and be like, hey, like that was pretty special, because, that the 10,000 person co-op or something, that's pretty large for the time. And people haven't held the token and actively participate in the governance of it as they perhaps should. But it opens that door to have that conversation of, okay, who really owns this thing? Who should accrue the value? Yeah, I think that's a really interesting, really interesting question.
Well, if you let people stake and they have an opportunity to increase the liquidity of the entire thing and there's different ways to do that. You're distributing the ownership. People are able to make money. Yeah.
Oh, that does. There was another kind of version of staking that that we should talk about, and it's not Uniswap, but it's actually the competitor SushiSwap. That this is also because we haven't really talked about forking. I know Kristen, you brought it up earlier, but the idea of if Uniswap isn't doing what people want it to do, then somebody potentially fork it. And this is what happened in the case of SushiSwap, where Sushi was like, hey, Uni, you guys should have a token and you guys should capture some of the fees and reward people who are governing the token, because we want somebody to have it's just good to have that. Like, you want somebody to be a steward of the project. And they were like, no, we don't want to do it. No, we don't want to do it. So the people at SushiSwap were like, okay, you don't have to do it. We'll do it. And that's what they did. They launched what was called a vampire attack on Uniswap. That's right. This is how the sushi token came to be. So it was a fair launch, but what you did is, instead of staking just like random tokens on from somewhere else onto your thing, you would actually stake your own sushi tokens. So your sushi liquidity tokens that sushi gave you, and then you would stake it back to them, be like, hey, I am providing liquidity on your own thing, and they would give you sushi tokens. So that was perhaps a yield farming craze that really took off, and I believe that's how they launched their token, was via providing liquidity on the SushiSwap exchange. When they did that, they drained a lot of liquidity out of Uniswap and it flooded into SushiSwap. That's the birth of the birth of Sushi was a vampire attack on Uni, and it was also a fork of Uni.
Interesting.
So
the vampire thing is like taking advantage of the host body sort of thing. Like they're using the mechanism within Uni in order to stake Sushi before.
Not quite. It's when you take a code base and you basically have the same code base, your protocols work in almost the same way. So users can take the assets out of the competitor and put it into
and just move it over.
Move it to yours with almost no work, right? They just have to click some buttons, maybe pay a little bit of gas, and boom, suddenly they're on your competitor, and the competitor was giving them tokens. And so people wanted these sushi tokens, so they're like, okay, well, I'm providing liquidity on Uniswap and I'm not getting any benefit for it. So why not do it on Sushi? And then when Sushi did that, that's when Uni actually had to release their token. They didn't have a token yet. And so they were like, oh, okay. And so they released their token. So that's forking. But the thing that the Sushi community really wanted from the Uniswap, I think, team at the time, I wasn't really paying attention. I wasn't paying attention to crypto at the time. So this is all this is not firsthand, but I believe they wanted Uni to charge a protocol fee. So they wanted to say, those 30 basis points that are going to LPs, keep 5 of them, give them to token holders, so that the people who govern this protocol have an incentive to continue governing this protocol in a way that maximizes everything on this protocol. And the way that you get access to that 5% on Sushi is that you take the Sushi token and you stake it. And everybody who's staking Sushi tokens are capturing, they're getting rewarded with that those 5 basis points. So every time someone's trading, that eventually accrues back to the Sushi stakers. So if you're not staking your Sushi, you're missing out on those rewards. If you are staking your Sushi, then you're getting the rewards. And I think when you stake, you can also vote. So so it's kind of a lot. I'm not 100% if you need a stake to vote, but I think you do. A lot of protocols are kind of like that. So
makes sense, because you're vested.
Yeah, you're vested, and you're also you're getting the dividends.
Yeah. And then steering that in a way that makes sense.
Yeah, exactly.
It wasn't part of the move from Uni to Sushi that the Sushi tribe wanted a DAO and the tokens in DAO, and then what happened was that Uni formed the DAO before Sushi could get the DAO off the ground because
I'm not super familiar with that. There might be, but I do know that there's another like kind of underlying thing to Sushi versus Uni is
okay.
this VC, like the VC backed project, which is Uni, versus the fully decentralized project, the populist project, which is Sushi.
Oh,
And so, remains to be seen which one will, how they'll evolve over time. Both really, really great. People like, obviously the populist one gets brownie points from a lot of people. Like I think everyone wants to cheer on the little guy, and that's everyone wants to do that. But then Uni has continued to like deliver like some cool stuff. And so it just is going to be this tension between the populist project that like, hey, they move fast, they respond to community feedback, they listen to people, versus Uni is like, hey, these are the big brains that are kind of in a room just thinking, dreaming up these big things, sharing once they're ready, but they're not necessarily working in public every day. They do drop these like pretty awesome things every now and then. So, but that's kind of like the tension. And that's emblematic of
It's a
lot.
good tension.
It's emblematic of a lot that happens in crypto. And so I think every team is somewhere on the spectrum. The fact that these two, this saga continues and continues to be interesting. It's definitely one to watch.
Good for development.
Yeah, I think it's good for both of them. They're both sort of like pushed on by this. It feels more like a healthy competition because it's a win-win for the greater ecosystem.
It is.
Like if people are viewing it as like a winner takes all, then that's on them, but it's not really like there's no loss here. Because if one of them turns out to be better than the other, or maybe there's room for both of them, there's just different styles. Like everyone's learning from each other.
Exactly.
Yeah.
What we're learning is that there is room for both of them. It is really interesting that's the case, but yeah, they are able to support. I think Uni has like, I haven't looked at the numbers, but like somewhere around 60% of volume. Sushi is fluctuating anywhere from I think 9 to 20. That's like kind of their range. I think they're somewhere but there's room for both of them.
I'm curious if the markets like niche out based on style and all this other stuff, like of governance.
And not just on the same blockchain, but even across blockchains, right? Like you had Binance Smart Chain really like open people's like eyes to the fact that, hey, not everything is necessarily going to happen on Ethereum, and it might be on somewhere else. And then Polygon was like, okay, if you are able to reduce the latency, also just have a lot more bandwidth, will people use it? And the answer was, hey, if you can convince the big projects like Sushi and Aave that this is legit, like to use the chain, people will go. And now you're seeing stuff like Solana, which is very different, probably the most different. It just cut from a different cloth almost, but it's beginning to take off. You're seeing stuff like Avalanche and Celo, which I'm not super familiar with, but I think they're also EVM based. These things are getting traction. And now you're like, okay, we have competition, not just on protocols, but also on, that first layer. And it might actually be very healthy for them to do that. So
they're different materials for different purposes, but some of them are combinable. Some of them can talk to each other.
So the idea of competition, it definitely, like competition definitely does suck. Like when you are one of the people in that fight, and you are really, I thought we were doing really well, and now somebody came along and stole some of my lunch, and it does suck. But overall, it's like both sides are pushing each other to do better, and ultimately, everyone benefits. And oftentimes, these markets can't sustain multiple players. There's I guess there are probably some markets that might be winner take all, but so far these have not been.
Well, I mean, if they're sharing information across the network, anyways, sorry, go ahead.
Oh, sorry. So you said like the market can't sustain multiple winners. Does that inevitably create sort of a race to the bottom in terms of like protocol fees? And
that's a really good question. Yes, it remains to be seen if that does create a race to the bottom. Yeah, that's a really, really good question. I think the like figuring out where the network effects lie, where the moats are in things like DeFi and these kind of projects it remains to be seen. I don't think there's an easy answer there. But yes, definitely competition will, in theory, reduce protocol fees. But if they go to zero, then the values they collapse to zero, so they can't be zero.
Right.
In theory, but maybe they can. Like it's just like the idea that okay, maybe one day we could always turn it on in the future that gives them the value, and it's perpetually like that, and maybe that's where the value comes from. So they could always be at zero, but we're always dreaming of tomorrow. So I don't know.
It
So
seems like quantitative markets might not be able to sustain multiple players, but in qualitative, like game, games and social tech, like there's going to be,
even in the quantitative markets, there are multiple players, and part of why the market is able to sustain them is in kind of governance style, like how the different projects govern themselves. So like you have Compound, Aave, Cream in the lending markets, and they each have their own little niche. Cream kind of lists long tail assets. They kind of just do whatever. They innovate a lot more quickly than the other two. Compound is, they're kind of like more like the Uniswap kind of approach, and Aave is kind of somewhere in the middle where they're like, hey, listening to customer feedback, we're innovating, but we also they want to become like a neobank, but they're also like pretty populist in the sense that I forget exactly how they got started or how their token got established, but they have a little bit more of a populist ethos to them. So all three of these, are they're able to sustain themselves. I'm not sure about protocol fees on them. I forget how that works. I'm not super familiar with the token economics of those protocols. I forget. But I think the protocol just takes a small part of the spread if they take any at all. I forget. But the governance structure is enough to sustain multiple projects, at least as of now. So I guess if I said that it is a winner take all market, I think I misspoke. I meant to say that it's not a winner take all market.
I probably just misheard.
Okay, my throat is beginning to get a little bit sore, so I might have missed a syllable or something.
Yeah, I mean, we can wind this down if you're.
Yeah, I'm still good. Yeah, if you guys want to ask another few questions, but yeah, that's.
Yeah, no. So do you like working for a big exchange? Like, what's the experience like?
Oh, we're still quite small. I think the team is like 30 something, maybe 40 people. But I do like working in. So we haven't talked about like what I do, but or maybe I did at the very, very beginning. But essentially, 0x it's a protocol for making trades where you can trade with another counterparty, where like, for example, I think I gave the example, Dave and I wanted to trade with each other directly. We could use the 0x protocol to do that. And the 0x protocol initially had this idea of an off-chain order book. So the order book would not have to live on chain. You could do a lot of stuff off-chain and then just settle on chain. And so this is really interesting because you're still relying on a lot of off-chain kind of computation and just certain things happening off-chain. But for the most valuable part of that transaction, the settlement of it, the atomic swap and some of the other features that are there, that happens on chain. So what we do now, though, is we essentially aggregate multiple sources of liquidity, which means we look at Uniswap, we look at Sushi, and we look at maybe like 30, 40 different other things. And when somebody says, hey, I want to trade token A for B, we check all of them and we say, okay, it would be best for you to trade at Uniswap. But then it's a little bit more complicated than that. Sometimes because of the price impact, it might be better for you to trade on both, to do half here and half there, or 75% here, 25% there. And so we figure out the splitting. And then the last thing that we do, at least right now, is we take a percentage, not percentage, the same time when somebody says, hey, I'm looking for something, we go look for we ping market makers. So professional market makers, people who are, they're trading tokens and trying to make spreads and kind of, offer great prices. We ping them and say, hey, can you offer a better price than what Uniswap or Sushi or whatever is doing? And if the answer is yes, then we'll present that option to the end trader. And so it's an aggregator of all of these exchanges with the source of liquidity that could potentially offer something better than anything that lives on chain. So it's kind of this interesting hybrid approach where the blockchain is still settling the transaction, and we try to get the best of all worlds, but then there's a lot of stuff happening off chain as well. And I work on a lot of the off chain kind of related things. But yes, it's been great. I really do kind of enjoy. Yeah, it's like figuring out that we talk about the human and the machine, right? Like figuring out what that balance is going to be. I think Xerox is a pretty interesting take where it's probably, it's relying less on the blockchain for certain things, but at the same time still heavily relying on smart contracts and the blockchain. So it's an interesting balance.
How long have you been there?
I've been there since March, so
March.
yeah. I don't know how
so pretty. Yeah. So my buddy Chris Kalani used to work there.
Yeah,
but he's gone off. Yeah, I don't know if you ever met him, but yeah.
We overlapped just a little bit. Yeah, he's
Cool.
working on the Phantom wallet for Solana.
Yeah. That seems to be
Very
jumping off. So he's
cool
doing
stuff.
all right.
Yeah.
Yeah, I had some question. I forget what it was. It was something probably related to, don't know, forgot it.
All good.
I mean, the hybrid approach thing, we're like starting to play around with this a little bit with publishing, like using the blockchain as media effectively. Yep. And then like off-chaining some of the stuff until it's ready for press effectively. So like, it's interesting hearing that approach. I mean, there's probably a bunch of sophistication in there that we can steal from.
Yeah. I guess the question is, why do you do some of it off-chain and some of it on-chain? Like, so, and then I guess this gets into a whole bigger thing about, and this is different cultures of the different chains. So you can do certain things faster or better if you're kind of splitting it, but yeah. And that gets into the trilemma of what is it? Security,
centralization and
yeah. So I'm curious if you have like a take on that for what you're doing. It seems that going off chain offers you an advantage. And so is 0x considered a decentralized exchange? Is that like?
It's still, it's a protocol for decentralized exchange.
Okay.
Yeah, it's kind of interesting because there's some stuff that does require, servers to be running to be able to make some of these. And so it's like, it's kind of this, there's an aspect of it that's this gray area. And then there's an aspect of it that, so all these aggregators have a component where finding the best splitting, a lot of that happens off chain. That calculation, that computation is very intensive. It's like you got to find a path, right? That results in the best tokens. And that is done off chain. If you did that on chain, the gas costs would be astronomical.
Yeah.
It would no longer make sense to trade. So that's something that for practical reasons cannot live on chain. And at least not with the current kind of fees and the way that Ethereum prices opcodes. But I think, this model of having that and on-chain, it does kind of blur the line of like how decentralized is it exactly? And I think that's a good question. It's one that I think, my answer is I think a lot of things are going to tend towards this direction, which is you're going to have a kind of something that looks like a more traditional backend, but then a lot of things are going to settle, or like the value is going to settle on the chain. And that's really, really, really important part. That's the accounting that we really, really, really want. And we can do other things, other forms of, just to verify the computation is good and correct. And we can all still do that on chain, but we're going to try to minimize what's on chain. And I think a huge part of the reason why we're doing that is because things on chain is very, very expensive. So then you ask, what happens in a world with Solana when you can do, let's say, let's give them benefit of the doubt and say that we can do 1 million transactions a second. Right now, that's orders of magnitude more than they can do today. Well, like, are we going to be now making tweets on Solana? That's an interesting question. I don't know exactly what a Twitter's TPS is, but it's pretty high. If you get Twitter and, all across the world, all these guys, I think, it's still going to be expensive to make transactions, even on that chain at scale. And so the question is, like, what is worth paying that cost?
And what do you get out of it? Like, why are you paying that cost?
Exactly.
Like the utility of, and we've been talking a lot about this, just the nature of blockchain as media, like the networked nature of it. What do you get from it at everything being on chain? And does it just get heavy then?
Right.
There's a lot of noise in the system. Well, there's probably different things you could do with the data on chain versus off chain then, depending on how it splits. Yeah. I don't know.
I think there's a social aspect to it that like gets you maybe an agreement of trust with the media that you can then build on in ways like it's, you know that this thing is backed by something at least. And then if there is a social cost to it, then because of a project or something else, there's the lineage there that you can check, which means that you can build, abstractions or tangibles on top of that stuff.
And the other thing that's kind of interesting is royalties. So you can track royalties off the web of contribution. And so if I cite, like, if you just create like, hey, my work built upon, the work of these people, here's here's their NFT that represents their media that I'm citing. Now, when you pay me, like, whatever payment vehicle will now trickle and pay everybody. That's also kind of interesting.
Yeah, this is where the retroactive public goods funding stuff is really interesting, because if you are working in a media that is on chain and the value may not be understood until a few orders down the road, then if that lineage is captured on chain, then you can like backfill the value to the person, which gives you an incentive to work in public and like offer up these things with the possibility that if what you're working on has higher utility, then it will be rewarded and can be rewarded like equitably, I guess.
Right.
So, or something close to that.
Right. Like if it costs you like 2 cents to do that, hey, like I wouldn't pay 2 cents to tweet, but I might pay 2 cents to basically to publish my work. Like and I can potentially make royalties off of that. Hey, that's a cost I'm willing to pay.
Yeah, I think that we're kind of banking on the idea that at least some of these properties can be something that is gameable enough to create like new forms of media that come from them. That if we offer primitives on this stuff, we don't know, we have no idea, but like if it's fun and composable, people will play with it and compose with it. So, and there are like sort of innate properties of the blockchain that are now exposable that we've not been able to play with before. So like some of these trust games and these other kinds, all of the swapping and whatnot is basically based on this. It's just, you can write to it now with the NFTs, or the JPEGs as NFTs are like the first round of this stuff, I think.
Right. Yeah, but just the tip of the iceberg. It's
totally.
NFTs are, I feel like I've been saying this all year, but we've now had like it feels like at least 2 NFT cycles, and it's like each time it comes back with a greater ferocity than last. When are we going to move past JPEGs? Like when is this?
I think we're there. The newer projects that are coming out now, like Shahruz has a better handle on all this because he's playing with it. Yeah.
Okay. I actually haven't dug in to this side. I've been kind of focused in the DeFi world, so I'm really curious to kind of get a sense like, what you guys have uncovered on the more media side.
I don't know, Shahruz, what have you uncovered? There's so
No
much
idea.
stuff. Yeah.
Everything, and no way to understand it or parse it or
Yeah.
feel that it's manageable.
I think I've been trying to write about this some, and these talks about the media properties or whatever are my way of doing it. But yeah, I don't know.
We could like sort of, I don't know, unpack a little bit of it, but that could be a next call.
Yeah,
Like
I think that would be good.
That'd be
sort
cool.
of
Yeah,
getting
I would
into
love-
it when we're more fresh.
Yeah,
Mhm,
definitely. Yeah, that's something that I haven't thought too much about. I haven't thought too much about the NFT space. The one space that I like am interested in is like, so right now tokens are still a plutocracy, which you have more tokens, you
Yeah.
have sway. It's a plutocracy, and there are things that there's that proof of humanity project and projects like that are trying
Yeah.
to kind of change that, which are really interesting. And I think that could potentially be the most important primitive for many projects. But yeah, again, and that's an interesting thing. Is like, okay, how much of that happens on chain? How much of that happens off chain? It's like,
Yeah.
there's an interesting question. And so, but yeah, no, I think that is where my mind has been kind of just like, the DeFi world, and then kind of investigating this concept of identity. But media, I've not thought about, and I would love to to see what you guys have found.
Poking around on it all day, every day right now. So
Awesome.
yeah, I don't know. This has been super helpful in like landscaping. Like there's a bunch of stuff that
I like
I
that,
had never.
landscaping.
Yeah. I mean, basically, that's what we're doing.
Yeah.
There's a landscape out there, and we're tending and pruning and
cutting
figuring it
shrubs.
out. Yeah, exactly. But and like so already like a good I think something to point to as one of these being successful is that we have a couple other threads of interest that like are ready to go. Then we have to cut ourselves off. So I don't know. It's generative in that sense. Like I would love to talk media amongst some other, like with different sort of a different group, and then or this group, it's fine. And then any of that governance stuff and like the implications on any of that stuff, I think is fascinating. So
Totally.
anything,
Totally.
So
Totally.
cool.
Yeah. Well, keep me posted on what you guys
Sure.
are thinking. If you guys are doing another one, would love to.
Yeah.
And perhaps as an audience member, and would be, dude, really, really excited to be able to have these kind of conversations. I think, this is the way. Just the more I think about it, just like, we're building stuff that is, it's like, this is like the printing press. This is like, this is a new thing that we don't know what the ramifications are. And I think we got to have lots of conversations, and we got to think about how do we do this in a way that's good for humanity, and not, not just rearranging the musical chairs. And so all these are really great conversations, and I really enjoyed this one today. And thanks for having me, guys. A lot of fun.
Thanks for being here.
Thank you.
Yeah, thank you, Phil.
Yeah,
All right.
thanks
Cool,
so much.
man.
All right, we'll
Awesome
catch you
having
guys
you.
later.
Later,
good.
dude.
Peace.
Okay, bye.
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 Bye.